$450,000 in just 9 months. Today, we're going to be discussing how a sophisticated, savvy investor navigated rising interest rates to make such a return. Guys, my name's Julian. I'm the head of strategy here at Ripe House Advisory. Today, we're going to be going through a couple of things. I guess we're going to have a bit of a review of a client of ours who purchased quite heavily with us in the back end of December last year. But I guess more so, rather than kind of give ourselves a bit of a pat on the back and walk through just the performance alone of these properties, what I really wanted to do was kind of have a bit of a high level overview in terms of some of the common questions we get here in an advisory environment at the moment. You know, are clients making fear-based decisions? You know, can money still be made with rising interest rates? And we'll go into this a little bit later. And what are the sophisticated investors doing? So we kind of go into this just a little bit here in terms of, is fear really kind of leading you down the wrong garden path when it comes to investing? What we're kind of having a look at here is we're having a look at a bit of interest rates. And what we can kind of see here, this is a bit of a longer forecast going at the 25-year timeline here. And we can kind of see back here, we had a bit of a pump of interest rates back up here in terms of GFC. So having some rising interest rates there. You know, the market then goes into a bit of a panic. People start panic selling. There's unemployment, which is a completely different, I guess, landscape we're facing now. We're actually having labour shortages and we're having to ship in migrants in record numbers to kind of fill those roles. But then what happened with that was in terms of we had some rate reductions, a little bit of a bump here. That was a bit due to the building collapse, and then there was continual rate reduction, all the way till we hit the bottom in 2020, 2021, where we basically had the cash rate at near zero and people locking in fixed interest rates. What happened from there, and we've kind of seen, we've had a record turn here where we went through a record uplift of interest rates, where we're now sitting with most investment loans sitting between kind of 6 to 6.5% in terms of interest rates. And investors are kind of sitting there in terms of like, oh, you know, is the bubble bursting? Has the bubble popped? You know, do I need to escape from here and make an exit point for myself? And what I want to walk through here is in terms of, we've got three main drivers when it comes to, I guess, property pricing or just any kind of asset or commodity out there. Firstly, you've got supply, in terms of you have to ask yourself, is supply an issue? You know, if you're going to buy any asset, let's say homes, for example, and you know, you've got new home after new home after new home being built and there's no one moving into the neighborhood to move into them, well then, yeah, you're going to have a bit of a problem because the demand for that property is going to be less, and that is potentially going to drive down the prices. Well, we aren't dealing with that at the moment. At the moment, we actually have the complete opposite, I should say, in terms of we have record low vacancy rates, and this problem is actually only going to get worse from here. We're having migration come in, population growth is still occurring, so that vacancy rate problem is going to be an issue. And that, in terms of the supply side is also in a bit of a spin as well, because we're having builders collapse and trip over themselves, and there's no labour force to come in and build those properties. So the supply and demand is really strong, and there's no supply coming in. So we've got the two ticks. But then we talk about consumer confidence, because consumer confidence is a big one. If people don't have confidence, and COVID's a good example of that. 2020, the property market basically went just on a standstill for a couple of months there. There was a bit of a standoff. Everybody's in lockdown. Nobody knows what's going to happen. But what we can have a look here, if we have a look at a bit of the chart, we're having a look at the consumer confidence index here. And let's go through a bit of a longer scale here. If we maybe go to GFC kind of time, so 2008, 2009, where we had the GFC hit, the bubble burst in the internet stocks, and bang, unemployment spikes. And what do we see here? No surprise, consumer confidence hits a record low at that time. The data, it only goes back to about the late 60s here, but we can see here consumer confidence hits an absolute rock bottom. And house prices really here in Australia barely moved. In some markets, like a US market, went backwards about 17%. But here in Australia, property prices only went back about 7%. So there wasn't a big crash per se. But what happened from there is, not long after that, consumer confidence increased. We see here, through this uplift period, what we're seeing here is construction grant, stamp duty concessions. We're seeing interest rate cut after interest rate cut, if we refer that back to the previous slide. And in that time, consumer confidence increased. And what we saw throughout that period, we basically saw a doubling of house prices over that period. But then if we have a little bit of a look here, we see, bang, behind me, we can't see it here, but I'll use my cursor here. We see the pandemic hits and confidence falls through to the floor. But what we see after that is we see JobKeeper, JobSeeker, we see the construction grants come through, consumer confidence goes through the roof, and so do house prices. But then from there, we've had a record, consecutive interest rate rise. And we actually hit the bottom here round about September, October last year is when we hit rock bottom. Coincidentally, around December time last year, we started to see this improvement on the consumer confidence index, and it's still continuing to track that way. But coincidentally, this sophisticated investor, which we went through today, he actually went out there and he didn't just purchase one property. He actually went out and purchased 6 properties in the month of December. And we're going to have a bit of a review of those and how they actually panned out for him. Because again, what we don't want to get caught into is fear-based mentality, and we don't want to move with the masses, because most of the time, 80% of the time, the masses are moving in the wrong direction. We want to think and act like a sophisticated investor, and we want to make calculated decisions. So we're going to look through here. One of my favorite clients to review here, because not only is he, an astute investor, he also holds a dear place to us here at Ripe House, because he does a lot of charitable work in his local community. So I'm really happy that this client performed really well and is continuing to perform really well. But if we have a look here, the first of the properties we purchased, so WA location, solid 3-bedroom, 1-bathroom home, 697 square meters of land. And we can see here the yield versus the purchase price when we initially purchased this just 9 months ago is 6.34%. So really strong rental returns, helping navigate those rising interest rates. But more impressively here, we've got $55,000 in growth in just 9 months. So that in that 9-month period, we're talking about we're on track to be about 17.9% capital growth. And there's even still been a $25 per week rental increase on this property over that short period of time. And we're going to get deeper in terms of the rental income on that one. So that's property number 1. Then we flick and go, well, maybe he just potlucked it here. He's bought 6 properties. Surely he can't continue to do that. We have a look here at property number 2. And this is actually the worst performing property of his 6. But we can still see here, solid property, 3-bedroom, 2-bathroom, 630 square meter of land. Yield versus purchase is 5.98%, so still really strong returns. We've made $30,000 on purchase, which is over an 11% capital gains. And we've had, again, another rental increase on this property, and we'll go deeper into that. We go, okay, well, we're 2 out of 6. Surely we can't keep this run going. Property number 3 here, we're back out in WA, 3-bedroom, 1-bath, or 750 square meter of land. This one actually has sub-development potential on this block. I've had a look at this one, but we've increased the value on this one. This is one of the better performing properties, $70,000, and he's got a 24.6% return in terms of capital growth, and again, a $20 a week rental increase. So 3 out of 6, we're striking at 50% already. Again, we move back out to Queensland here. We're looking at another brick home in Queensland, 4-bedroom, 2-bath. Again, another large parcel of land, 600 square meters. Yield versus purchase, this one's pushing 7%, so 6.98%. And we can see on this property, $40,000 increase in value, 13% capital growth in just the 9 months. And again, another $20 a week rental increase. So we're 4 out of 6 down. How is he still going? This sophisticated investor with a really high net worth. Property number 5, again, back out to WA. 3-bedroom, 1-bath, 818 square meters of land. Yield versus purchase of 7.12%. So this is a property, again, really helping us navigate that high interest rate territory we're in at the moment. $70,000 increase in value, a 28.3% increase in terms of capital growth. And again, another conservative $20 a week rental increase there. So we're 5 out of 6, and property number 6, back still in WA, 4-bedroom, 2-bathroom property, 594 square meters of land, yield versus purchase, again 6.2%, $100,000 increase in value. So this is one of the higher price point purchases, but again, still 27% capital growth. And again, another conservative rental increase there. So guys, astute, savvy investors like this, who have had to navigate these kind of turbulent times before, they get in there and they don't make fear-based decisions. They allow the data to guide them and make the correct calls time after time again. And we can see here he hasn't got 3 out of 6 or 4 out of 6. 6 out of his 6 properties in these approved locations have netted him a significant return over just a 9-month period. So if we have a bit of review, and I guess one thing to be aware with this investor situation. So he actually had a property in New South Wales. He sold, and he essentially it's loan porting. It's not super common, but he ported the loan amount on that property all across these 6 properties. So he actually didn't pick up any more loans, but the reason for that is because firstly, that property was netting him $890 per week in terms of rent. So it was heavily negatively geared. Compounded by that, he was paying a $25,000 plus land tax bill. So we've got a negative geared asset in a market, in that Sydney market, which wasn't flagged for growth and essentially hasn't gone anywhere since we transacted on that purchase, or he sold that property purchase, which again he made on his own accord. But it's turned out his decision has netted him a significant return. So across the 6 properties, he's made $365,000 in capital growth value. Then we move on to the rental increase versus his previous property's income. He's made an extra $86,000 per week in rental cash flow. Then we compound that by the land tax he's saved from New South Wales at $19,000. So in just 9 months, he's made $30,000 short of $500,000. So even if we want to go, well, that's okay, he's done this over 6 properties. Well, guys, in 9 months, that's still around an $80,000 return if it was just the one property that he purchased. So it's significant returns that can be made when we act sophisticated, we make calculated, rational decisions. And if we look at here, 15% capital growth in 9 months. So we're not talking about he's prorated to achieve 15% capital growth. That is 15% capital growth already today as of 9 months. In a 12-month period, he's on track to achieve 20% capital growth. So again, sophisticated investors know what they're doing. They navigate these turbulent times and make the correct decisions time and time again. Guys, I hope you got something out of today's video. Like I mentioned, my name's Julian. I'm the head of strategy here at Ripe House Advisory. If you're not already subscribed to the channel, please make sure you do. We put out constant content. We want to make sure we keep you informed and educated along the way. If you're not already, follow me on LinkedIn. We've got more data reports and slides coming out of that space in just a little bit. And we also have a significant project being announced in the coming weeks. So I really look forward to that. Speak to you soon, and thanks again. Bye for now.